My favorite account, hands down, is the superhero account. Now, many of you have not heard of this account before because that's my nickname for the account. The real account name is called a brokerage account, or maybe you'll see a joint account, or an individual account, or a non-qualified account. And I don't know why there's so many names for it, but it's my favorite account because it helps you retire early. There's so many benefits from it. I put out this video recently why the superhero account is crucial to retiring early. I put out this video, 7 key tips about the superhero account that you probably don't know. And this is something that I'm not saying is the best account because we know Roth IRAs are amazing, tax-free growth forever, and it's something that many of you will share. Well, isn't that account better? It's different, and you want to make sure you're using the right account for the right situation. And many of you want to make sure you're withdrawing from your retirement accounts by the time you retire in the most efficient manner to pay less in taxes. That's where the superhero account comes in. I can tell you right off the bat the reason I love it. There's no limit to how much you put in. And when you pull money, you get to pay capital gains taxes instead of ordinary income. Capital gains taxes, as a reminder, is lower tax brackets than ordinary income. I mean, it's hard to beat 0%. And yes, that is perfectly legal. It's not like that Ozark Netflix show, if you've seen that. This is not illegal stuff. It's perfectly legal to pay 0% in taxes if you're managing your situation well. By the way, if you don't believe me on why superhero accounts are my favorite, just check out this comment. Superhero account really is underrated. Long-term capital tax rate, no RMDs later, freedom to invest how you want, and it even gives flexibility to retire before 62. Hard to beat. Check out this other comment. Real superheroes have tax diversification. Allocate to 401k, taxable, and Roth. Imagine being able to decide how much of your money is income and optimize based on that. The Medicare threshold is a great point in this video. RMDs and Roth conversions are another. So if you look at any of my superhero account videos, you'll see the comments are just so many people going, yes, please consider this account. Now, there's a huge mistake I'll see when people have a superhero account. What they'll often do is they'll have tons of dividend paying stocks in this account. And some of you are like, what's the problem? I want dividends. So do I. I want you to have dividends. The problem is if they're in your superhero account, you might be paying way more in taxes than you need to. So that's why you might want to hold dividend paying stocks in an account like an IRA because you're not paying taxes every single year on the gains, on the interest. You want to make sure you're holding the right types of investments in the right types of accounts. Now, if you don't know anything I just said, I don't blame you because I didn't know that stuff until I was once told it. So I'm going to be explaining this in great detail to manage your tax burden in specific accounts that are not retirement accounts. So I have tons of videos on 401ks and IRAs and Roth IRAs. I even have a lot of videos on superhero accounts, but I've never done one so tax oriented, which by the way, the reason I'm doing this, most of you, the best thing for your tax situation is to pull from this superhero account first in retirement. Why? It keeps your income low. You can implement tax gain harvesting. That's where you pay 0% in taxes. And if you do this well, you might be able to qualify for a healthcare subsidy. You might be able to execute another tax strategy like a conversion, which is going to be super helpful for you because if you do that, you're saving your future tax burden. So as a reminder, I personally use a CPA. I love CPAs, but the harsh truth is their job is to save you on taxes this year in a good way so that you pay them again next year. Nothing wrong with that. That's why I pay CPAs. That's not my job. My job is to save you the most over the course of your life. So I'm looking at long-term tax liability. And if you had a superhero account, but you were having to pay $20,000, $30,000 a year in taxes because it's a healthy account, because you weren't managing what's inside that account, well, that's defeating the purpose of what you did such a good job of accumulating. You work so hard to get a healthy balance in your superhero account. I don't need you paying unnecessary taxes on it. I want to make sure you're using it wisely. So obviously I love this stuff. And many of you will ask me, Ari, what supplements are you on? Because you get a little jazzed up when it comes to this financial stuff, the superhero accounts and all this retirement stuff. The truth is, I don't even drink coffee. Now, if you don't believe me, you can put that in the comments below. But in all seriousness, there's one ask I have of you. And just be totally honest. Do you have a superhero account? I don't need you to tell me the exact balance and tell the whole world on YouTube, but if you have a superhero account, please say, yes, I have it, and here's why I wish I got it earlier. Or you know what? I overfunded it. What's been your experience with superhero accounts? Because when you say it in the comments below, I promise, guys, people listen to you way more than they listen to me. I love talking about this stuff, but when they're hearing it from other people like you who are in a similar stage of life, it just hits different. And my goal is to help as many people as possible retire early. So yes, I'm here to educate. I want to explain things in a way that helps you guys understand how to minimize tax burden, but it's awesome when you guys share with each other. So please talk to each other in the comments. Thank you. And a final reminder, my name is Taublieb. I'm a certified financial planner, host of the Early Retirement Podcast, and Chief Growth Officer here at Root Financial. If you want to optimize your finances so you can spend your time on what matters most, make sure to scan this if you're watching on the TV, or go to the description and you can see a link to take you to our website, rootfinancial.com. A little button in the upper right says see if you're a fit, answer a few questions, and we'll see if we can help you. So check this out. This is a guide for all of you. It's all available in the description of this episode. You can take a screenshot. I'm not trying to make it so you guys can't access this information quickly, but I want to make sure the video is made for you in an effective manner. So I'm not going to read through everything in here line by line, but you can see the title here. What issues should I consider with the income from my taxable non-qualified accounts? AKA, if I pull money from a superhero account or a brokerage account, what should I know? So of my checklist, I'm going to go over the key points. Once again, the full checklist is available in the Early Retirement Academy, which comes with software so you can plan out your own retirement. Number one, and this once again is a checklist that I encourage all of you to consider if you do have a superhero account. Do you need to review how your non-qualified accounts, dividends, interest, and capital gains distributions are projected for the remainder of the year? By the way, that's probably all of you need to do that. If so, consider the payment frequency and timing to ensure you're accurately estimating the amount of additional dividends, interest, and gains. Be mindful of how this is going to impact your income. Maybe you're trying to qualify for a healthcare subsidy. Maybe you're just trying to make sure you have the right account. Maybe you're just trying to make sure your investment is worth keeping. Pro tip here, by the way, don't fall subject to just wanting absolutely all dividend stocks. Make sure you understand total return. If there was a stock that paid a 2% dividend and grew at 2%, that's a total of 4%. Would you rather have that or a stock that paid no dividends and grew at 5%? Understand total return and don't just fall subject to always wanting dividends. The good news is there's certain companies that grow really well and pay dividends, and we want more of those. Number two, do you need to review the dividends and gains election in your non-qualified account? If so, consider whether it makes sense for your situation to automatically reinvest dividends and capital gains distributions, which automatically step up your basis, or take them as cash. Most of you have a little button that will say, include dividends being reinvested. Do you guys do that? Let me know in the comments below. Many people opt to do that because it makes it so that too much cash doesn't end up being held in your Schwab or Fidelity or Vanguard account. So this is a common practice that if you haven't checked that box, I'd strongly consider looking into it. Number three, and I'm only going to go over my 5 biggest points, even though there's literally 30 in here. Do you have holdings in your non-qualified account that pay out tax-exempt dividends or interest, aka municipal bonds? Many of you know this about me, but my previous company, Nuveen specializes in municipal bonds, so it's all I talk about all day. Would it make sense to put a municipal bond in a Roth IRA? No, please. It already is tax-free, depending on the type of bond, where you live, there's many consequences, there's many things you need to know about, but when you think of a municipal bond, it generally is tax-free. So does it make sense to put a tax-free asset that might not grow that efficiently in a Roth IRA that's already tax-free? No, but if you're in a state like California, where I live, if we have a municipal bond, maybe it makes sense to have that in a superhero account. Number 4, do you have REITs, real estate investment trusts, in your non-qualified account that pay out dividends? If so, be mindful. You might be able to claim the QBI Section 1998 deduction. And by the way, a real estate investment trust, they generally do pay out significant interest and dividends. So if we're owning a tax inefficient asset, do we want that in a tax inefficient account? Generally, no. There's so many more. I'm just going to read off a few here. But one is, are you considering making Roth conversions this year as part of your tax strategy? If so, consider the extent to which your non-qualified account income will reduce the tax bandwidth you have available for making conversions while in optimal tax brackets. What the heck does that mean in English? Well, let's pretend that you want to do a Roth conversion, but you have tons of dividends and interest coming in. Let's keep it simple with an example, because that's just how I learn personally. Pretend your income is 0, you're retired, but it's not really 0 because you have dividends and interest. So now your income is really 30,000. Well, if 30,000 is coming in and you want to do a conversion effectively, let's say you want to convert 50,000 from your 401k into a Roth IRA. Well, if you would convert 50,000, you're not going from 0 to 50, you're going from 30 to 80 because you already have 30,000 coming in the door. So with Roth conversions, you need to take all your income into account. Roth conversions create more income. It's like being paid more. There's so many other things. Are you planning to give to charity? Is it an irrevocable trust? Are you going to give to family members? Do you want to make sure that that step up in basis is crucial? Because many of you recognize the value of a superhero account. Guys, if you pass away, let's assume I bought Apple stock for $100 and it grew to 10 million. Well, first of all, I think I'd be very popular in my family. What do you guys think? But if I were to pass away, maybe I'd be too popular and they'd want me to pass away. Hopefully not. But if that was the case and I passed away, they bought it as if it's worth 10 million. They don't have to pay all the gains. It's a step up in basis. That's not how it works with an IRA or a 401k as an example. There's a schedule that your partner, spouse, or heir would have to pay taxes on, and it gets very complicated very quickly. I've done many videos on those as well, but this is just a summary. Non-taxable qualified accounts, aka superhero accounts. It is my favorite account. If you want to go into detail about truly why I love them with examples, make sure to check out my other videos. Today is all about what's everything you need to know. And I know there's a lot here. So please, I encourage you to get this checklist. Make sure if you click off all those things, yep, I'm worrying about that. Nope, that doesn't bother me. You know that you're optimizing. Now, once again, this is a lot. So by no means am I trying to give you more work. I try to give you as much information possible so you can make the best decision for your own finances. But as a reminder, this is what we love to do. So if your superhero account is important to you and you recognize the value and you want to make sure you're optimizing it, it's why we exist. We want to make sure we're doing everything in our power to help you retire earlier, spend more, and live more. Because we like to say the sign of a good financial plan is a life well lived. That's it for this episode. See you guys next time.